Is 2022 the best time to buy a house? Is 2022 the best time to go to Walt Disney World? For the vast majority of you, the answer is no. I get it, completely understand. Spend your money how you need to. There is a small percentage, and if you are in that does want to buy a house right now, definitely reach out to me because I can help you. And there are some people that now would be a great time to buy a house for, especially if you don't live in one. That would be a great opportunity now to get one. So if you're in the 90% or more that says no, now is not the best time to go to Walt Disney World or to buy a house, this video is for you. What I want to do is take opportunity now when people are disinterested to showcase and educate people on how to figure out for themselves when's the best time to jump back in. When is the time? I mean, eventually things change and you will want to make the move to get back into the real estate market. So how exactly do we do that? I'm Sean Faulk. I'm a realtor here in the Orlando area, and I'm also a mortgage loan originator, and I'm definitely a good resource for this and an expert on the subject. So I want to compare Walt Disney World with the US government so that I can speak in layman's terms about how the economy and inflation works and just to explain how we got here. I don't think if you don't have this baseline understanding of supply and demand and inflation and all this stuff that you really can't end up with a good grasp when the time comes and as you're doing your own research if you don't get the fundamentals of how things work in business. So in business, things want to make a profit. Company wants to make a profit. Workers want to make money. Everybody wants to make money. And we're putting money out there. That's the economy as a whole. In this instance, Disney is going to have its own economy and the United States is going to have its own economy. How is it run? How does that work? Think of it in terms of the US government is the heads of Walt Disney World. There's Bob Chapek, who's over, Disney in general, and then there's people over the individual parks, and then they're over merchandising, or they're over this. So there's all these heads that are getting together, just like in the US government, and they're figuring out what the price is for things. Of course, at Disney, it's a flat, hey, popcorn bucket, Mr. Toad's Wild Ride is X number of dollars. But with the US government, they're going to be printing money with the Treasury and they're going to loan it out and get money for it. So if you want money because you don't have it, so you want to buy a car or a house or whatever else, you need to go to a middleman usually and get your money from a bank or a lender or whatever, and then they got to pay the US government back and you got to pay back them and whatever else. So that's going to be the interest rate or the mortgage rate is what's owed back. So that's how the US government can control that. And of course, just like Walt Disney World, they have programs, they have itineraries, they have these things. Okay, we're going to offer these programs to people. Just like Disney's like, we're going to offer these perks to our guests, to people who are spending money with us. These are opportunities you have. So the opportunities go to the guests slash citizens, guests being Walt Disney World, and with the US government, it's citizens or people who live in the United States. That's going to be the vast majority of the economies here, like 90% of it, I would say, because that's just regular people going to Disney, living our lives in the US, and we're pumping money into the economy. We're buying food, we're buying drinks, we're buying hotel experiences, we're buying houses, whatever. So Disney, hotels, whatever else you need, food. Same with the US economy. You're buying a house, you're buying a car, you're investing money, you're pumping money through it. Then there's the other section of people who are shareholders and investors. And they do overlap because obviously they're guests too, they're citizens too. But the difference is they are taking their money and they may give it to Disney or they may give it to the US government through bond securities or whatever else. Those people are expecting money back. They want a profit back for what they're putting in. Whereas the regular guests or the citizens, they're spending money and what they're getting back is a net loss in money, but they are gaining an experience. They're gaining, quenching their hunger or thirst. They're gaining something because they're giving money to get that experience back out of it. But they're not gaining money profit. So that's really the big difference. So if you're the US government or if you're Disney, you have to try to balance and maintain both of those things. Both sides are giving you money. But how do you keep them happy? Because this side wants money back because they want you to turn a profit, and this side wants a good experience. So how do you pick? The US government's in the exact same boat. Companies are in the same boat. How do they make shareholders happy while also keeping guests happy, or their purchasers, or whatever, the buyers, the customers? How do you keep them all happy? In this case, what has been going on is there is too much demand and not enough supply. Very basic economics. Demand's up, supply's down. What can you do to fix that? You either have to remove the demand or increase the supply. Walt Disney World and the US government cannot increase the supply. We're talking about homes here and Disney. Disney cannot overnight manifest a new theme park. The US government cannot overnight manifest millions and millions of homes that are needed to meet a shortage. So that's not an option. Increasing supply is not a choice. So all we can do is decrease demand. How do you do that? You go up on the price. Like, it's that easy. You just, hey, pay more. So Walt Disney World, as we all know, was like, we're going to make you pay more money to come to the parks. We're going to make you pay more to get in. We're going to make you pay more to stay at a hotel. We're going to make you pay more. You can buy Lightning Lane. You can do all this stuff if you want to, and we'll give you these options. The US government did the same. The Fed gets together and they decide how much are we going to charge people, and not so much people, but their middlemen, banks, all this stuff, so that when we print money and we give it to them, how much interest do we get back on this money? Lending you $1, I want money back, and then some. So they get together, and then when there's too much demand and not enough supply, they just go up on that percentage to discourage you from taking out a loan with the bank or with a lender, so that you're like, hey, it's not worth it to me to take it out right now. So maybe I will not use my credit card to buy a cruise. Maybe I won't take out a new loan for a house. Maybe I won't take out a new loan for a car because now I have to pay more back. That's interest rates or mortgage rates or whatever you want to call it. There's different names depending on what category you're in. But then there's good ways to track that, like the 10-year treasury bond, the yields you can track on all these charts that are online. And I'll make more videos going into those because there's like 3 months and 10 years and 20 years and all this stuff that you can hold bonds or securities at that point if you're getting long term. So this is the way that people deal with this, and buying a bond or a security lets you buy directly into the US government the same way you could buy stocks into Disney. That's the easiest way to explain that. So when that fails, which it did, in case you haven't known, because everybody's still out buying stuff and everybody's still going to the Disney parks, they're as packed as ever. Then you have to roll back perks. So that's step 2. And that happened. So now Disney is like, we're not giving free airport shuttles anymore. We're not giving free fast passes anymore. We're not doing free dining at this point. We're not going to give these perks, extra magic hours. If you want that, you got to stay in a deluxe hotel, or you got to pay for like Moonlight Magic, whatever. The US government does the same thing. We're going to roll back programs. We're going to make it more difficult for you to get the loans. We're going to have more hoops to jump through. So it's not as easy, and it discourages you from moving forward. That's the only way to do it. Hasn't been working. So that has not worked either. And they're going to keep going up on rates, and they're going to keep going up on prices at Disney. And when you ask, well, where does it end? It ends when people stop spending money. That's it. There's no like magic science behind it. There's no anything. It's when you decide enough is enough. When you decide Disney's gotten too expensive, I'm not paying for it. If everybody got together and didn't pay for Lightning Lane, they'd get rid of Lightning Lane. The same thing with the US government. When people decide that interest rate is too high, I don't need a car that bad, I'll keep my car. I don't need to upgrade my house. I don't need to buy a video game system. I don't need a cruise. I don't need these things, because the rate for me to pay the loan back, if I can't afford it, is too high, so I'm not spending. That's it. Until that happens, we'll keep going up. I don't know when that's going to happen, because we don't know how high it's going to get. But the way that you at home can base that, one of the most simple ways, is by following the Fed. As I said, when the Fed gets together, like they just recently got together, they're deciding how much extra or how much less it's going to cost you to borrow money. Right now, it's extra. So they just went up 75 points. And a point is like 0.01%. So 75 points is 0.75% or 3/4 of a percent. So which is a big jump. I mean, that's a lot for one section. And they've done it a couple of times, but the interest rate was so low before. Like that's why it's had to jump so high. And you mainly have to discourage investors. That's you once you get them out, then it settles down a little bit. And that is starting to happen a bit where investors are like it's just, I don't know that I want to take out new debt because it's not worth it to me. So that's what we're looking for. So when you're following along at home and you see, oh, the Fed got together and they went up another 75 points, you're going to say, okay, so we're still in the same boat. But when you start hearing, oh, they went up 50 points or they went up 25 points, or they'll say zero point 0.5 or 0.25, whatever. Then you know, hey, I guess it's working because they're settling things back down. And so I might want to get interested in starting to gear up to buy a home or buy a car or whatever it is that you're looking into buying. So if you're looking into purchasing a home, now is a great time to start educating yourself and start figuring out when's my best time, when's my best plan and strategy. You can also reach out to me and I will help you figure that out. As a mortgage loan originator, we want to make sure your credit is in a good place. That's going to really affect things. And it's not just like your credit score, because you could just start new credit right now and have a really high score, but it's the length of time you have credit. Maybe you have stuff on your credit that you need to fix. And this will give you a year, 6 months, 2 years, whatever the time frame ends up being, to fix your credit, to figure out your credit score, to figure out how long you've had stuff and see what would you even be approved for if the stars align and if things happen. But if you wait a year or two and then the economy or interest rates get really low or mortgage rates get low again and you're like, now's my time, and you come to me and you're like, hey, I'm ready to do this, you may not be able to at that point, and then you'll miss the boat. And there's plenty of people who missed the boat the first time around, not the first time, but 2020, 2021, when rates got super, super low. They were in a spot where they couldn't buy at that point, and now they're like, hey, I can't buy now at all. I've heard the story 100 times at this point. So that's what we want to do. So definitely reach out to me if you know in the next year or two you're going to buy, especially if you're a first-time home buyer, because there are programs out there, but really we want to get you helped and focused and make sure that you are really gearing up for what you're getting into, and we find the exact right time to get you in. So if you're interested and you want to reach out to me, feel free to do so at the email address below. And I promise it is not all doom and gloom, but these videos are to educate you. We had to start baseline, and I really hope that people learned something and you took something away from this, and educate yourself, whether it's here or with a different YouTube video, article, whatever it is you need to do. Just make sure it's unbiased. Don't let somebody pressure you into spending your money into something, and don't let them like scare you into it, because there's nothing to be afraid of right now that's happening. It's just things go up and things go down. Be patient, just wait it out.